Hello. In this video, we're going to be talking about accounts receivable, specifically how we estimate for the allowance of uncollectible accounts. As I've said in a previous video, that one of the approaches to estimating the allowance for doubtful accounts is we have to take the balance sheet approach, which means that we look at our accounts receivable and then our allowance for doubtful accounts or allowance for uncollectible accounts, it's the same thing, and determine what is the appropriate amount they should be and book those to be the appropriate amount via the bad debt expense. So the question is, how do we estimate what our net accounts receivable should be, if you will, where we have the gross accounts receivable, but then we need to book the allowance for uncollectible accounts so that the net amount is the true amount the company believes they will be able to collect. Well, there's this thing called the current expected credit loss model, or the CECL, and it said that estimates should consider all receivables and be based on all relevant information. You can include historical experience, any sort of current conditions, or any reasonable and supportable forecasts. So basically what it's saying is that there's no set way to estimate your allowance for uncollectible accounts, but it can include many things, and it could vary by client to client or company to company. And you could be done by looking at each customer account and determining what's the likelihood that the company will be able to collect on that AR. You can apply an estimate of a percentage of bad debts to the entire outstanding receivable balance, or you can apply percentages to different accounts receivable balances depending on their length of time outstanding. So let's look at that example. It's an accounts receivable aging schedule. And in this method, what would happen is a company would look at all their accounts receivable by each of their customers and determine how long has the accounts receivable been outstanding, meaning how long has that accounts receivable been on their books and still not paid. And the further out you go, the longer the accounts receivable has not been paid, the more likely it is that you'll not be able to collect on that. So in this example, they looked at their accounts receivable outstanding for the last 2 months, and they said, oh, we have $220,000, and we think there's only 5% of that, will not be collectible, so that's $11,000. And then we look at 61 to 90 days, the accounts receivable that have been outstanding or not collected, and it's $50,000, and we think there's a 10% chance that won't be collected, and so on and so forth. So when you get to the very last one, anything over 120 days, which in this example is 10,000, it's a high likelihood that that account receivable will not be collectible because it already has been so long, it should have been collected already, so you can see that these percentages keep going up as the days go up as well. So in this example, it says that the allowance for uncollectible accounts should be $25,000 based on a December 31st balance in your accounts receivable for $305,000. Let's take this example of, it says at the end of 2028, Hawthorne has a gross accounts receivable of $400,000, but believes it will only collect $360,000. And they've determined that based on the aging schedule, not from the previous slide, this is just a different example, but based on aging schedule, that their ending allowance should be $40,000, right? Because they only think they'll collect $360,000. So here, the ending balance in your allowance for uncollectible accounts should be $40,000. In this example, their beginning balance, or what they had on their books, was $11,200. So they would need an entry to make this adjustment they would need to increase their allowance for uncollectible accounts by $28,800, and they would debit bad debt expense. I want to go through just, a couple of scenarios with the allowance for doubtful accounts. So if Hawthorne had written off so many accounts receivable during 2028 that the adjustment account had a balance that was a debit of 2,000. So if at the end, we still need a $40,000 ending balance in our allowance for uncollectible accounts, just coming from the previous slide. But because we had so many direct write-offs during the year that this account actually had a debit balance of 2,000, in that situation, we would debit bad debt expense for 42,000 and credit the allowance for uncollectible accounts for 42,000, so that the ending balance is a credit balance of 40,000. Or another scenario could be that if let's just say your starting allowance for uncollectible accounts was 11,200, and based on an aging schedule, the company determines that the allowance should only be 5,000. So in that situation, they would debit the allowance for uncollectible accounts and credit bad debt expense. So this is just showing that the allowance for uncollectible accounts isn't always a credit balance to begin with, nor is it always a credit in the journal entry as well. So far, we've been talking about the balance sheet approach, which again is getting your allowance, your net accounts receivable right via adjusting the allowance for doubtful accounts or allowance for uncollectible accounts. Another type of approach is the income statement approach. And in the income statement approach, the company will estimate the bad debt expense directly as a percentage of the period's net credit sales. So they have to look at all the sales that they have on credit and then take a percent of that and decide that that's going to be their bad debt expense. So if Hawthorne had sales of $1.2 million in 2027 and estimated that 2% of those sales would prove uncollectible, it would debit bad debt expense and credit the allowance for uncollectible accounts for 24,000, just like in this entry. So in this situation, they look at their sales and determine what percent will be uncollectible as an estimate versus looking at their balance sheet and determining how much they think will be collectible based on the gross accounts receivable. Sometimes companies take a combined approach with combining the balance sheet approach and the income statement approach. And so here, for example, Hawthorne can estimate bad debts on a quarterly basis using the income statement approach and then refine the estimate at the end of the year using the balance sheet approach. And so if they had, before the end of the year, before they closed their books, they had an allowance for uncollectible accounts for 24,000, and they determined it should be 25, they would just increase it for 1,000 via the bad debt expense. Let's look at this problem. Berkeley Associates uses the balance sheet approach to estimate bad debt expense. So we know already we're going to look at our accounts receivable and our allowance for uncollectible accounts because it's the balance sheet approach. It started 2027 with a credit balance of $10,000 in its allowance for uncollectible accounts. Let's just try a T account for the allowance. And it tells me that we started with a $10,000 credit balance. Then it says Berkeley wrote off $200,000. So to write off $200,000, it would have debited the allowance for doubtful accounts, and then would have credited accounts receivable. So this would have been debit to the allowance and credit to the accounts receivable for $200,000. That's what that entry would look like right here. So I'm just kind of going through the T account of what happened in this account throughout the year. So they wrote off $200,000, and its aging of accounts receivable at 12/31/27 indicates it should have a credit balance of $5,000 in the allowance account. So it's telling me that at the end of the day, I should have $5,000 here. So 10 minus 200 gives me debit balance of 190. And so to get a credit balance of 5,000, I need an entry, a credit entry of 195 to the allowance account. So that would be a debit to the bad debt expense and a credit to the allowance account. So let's see. Yep, debit to bad debt expense of 195 is correct. And here is probably a neater version of what I wrote. I just wrote it out in a T account format. We started with 10,000, less 200,000 was written off. Our ending balance is 5,000, so this bad debt is a plug. And then really quick, I'm just going to erase that just so you can see the journal entry here is debit bad debt expense 195 and credit allowance for uncollectible accounts 195,000. This last slide is just a recap of the previous slides of how we measure and report accounts receivable. Well, first comes the recognition of the accounts receivable, and it really depends on how much revenue we recognize, because for most credit sales, the revenue is directly related to the receivable. So we earn our sales on credit, and then we record our accounts receivable. And then we say, okay, well, are there any discounts that are going to be taken, right? And we don't know that until it actually happens. And are there any sales returns that we should reduce our accounts receivable by, or sales allowances? Then third step is a subsequent valuation. You have kind of a net accounts receivable, not a net. You have your accounts receivable after recognition and initial valuation, and you look at that accounts receivable balance and determine how much of that do we think is going to actually be collectible. And then for the amount that we don't think is going to be collectible, we're going to record an adjustment in allowance for uncollectible accounts. So when you add up the accounts receivable plus the allowance, it equals the net accounts receivable, which is what the company expects to collect versus what it has versus what is on their accounts receivable account. And then you have to classify your accounts receivable. Is it a current asset or non-current asset? Typically, almost always, it's a current asset because typically accounts receivable are paid within 30 to 60 days.